Hello and welcome back to Bunnex Investment Group. Today we are going to be talking about supply and demand zones, or literally resistance or support zones. By the end of this lesson, you will understand the supply and demand price action concept. You will also be able to draw the zones of interest on any tradable asset. But before we jump into the whole video, make sure you check out our free Telegram channel where we share free signals, trading support, as well as advice. You may as well check the notification bell icon so that you'll be notified each and every time we upload a new video. Without wasting much of your time, let's jump into the content. So, the first question is, what are supply and demand zones? So we are going to define the supply zone first and later define the demand zones. So the red zone is marked as a supply zone. This could be defined as an active resistance area or a place where traders are selling huge amounts. These levels are more broad than resistance lines. Basically, we know that a resistance line will be a single profile where we would expect to see the market to reverse. But a supply zone is basically a region, and I'll show you how to draw it later. So make sure you watch to the end. So they are similar to resistance zones, but different in such that they cover a larger region. Then what are demand zones? So on the other side, a demand zone is a broad area of support. It is also a level of concentrated bias in converse to the supply zone. So this is how a demand zone looks like, and it's basically derived from the line of support, and it covers as well a larger region than a single profiled line. So supply and demand zones can be used with equal success on all time frames, but I recommend them to be used on at least, I left out M15 time frames, because anything below that consists of a lot of noise and false signals. So how do you determine supply and demand zones? Basically, to determine these zones, we use exponential moving averages, whereby we'll go for the moving average of interest and try to look from the left where a supply or a demand zone was once issued. So let's go over the explanation of how they work. Moving averages are of course lagging indicators, but can be useful in showing us the zones of supply and demand. The EMA theory states that whenever a small period moving average crosses a bigger period moving average, expect the market to pull back to the bigger period EMA region. So what do we mean by this statement? Let's take for instance 50 crosses 80. This is a 50 exponential moving average, and this is an 80 exponential moving average. After this has occurred within the markets, we expect to see the market coming back to the 80 EMA region and reverse. So the EMAs that are used by hedge funds are the common 13, 50, 200 period. Therefore, to attain the EMA supply or demand zone, the above theorem applies. So here are the steps in getting the EMA zones. The first one is to look and anticipate where the market is going to pull back using the EMA theorem. Which EMAs have crossed and which one do you expect to be a guard of the price when it pullbacks to it? Look at the left side of the market and find the nearest area of consolidation to the region of the EMA pullback. What do we mean? Let's take for instance 20 crosses 100. An EMA crossover has happened at this point. we know that we are expecting to see the price coming back to the bigger period EMA and take off. However, it's not wise to take only a trade at the EMA. Why? Because it actually looks for a zone of demand, in this case from the left side. So our job is to look for a point of consolidation, or a point that once acted as a support in the past, which is in the region of the EMA that we wish to see price pulling back from. So the nearest area of reversal to the region of the EMA pullback is the one that we will be looking for. After the above steps have lined up, try to draw a horizontal line of best fit, which will then be changed into a zone. I will show you how to draw the zone. So here is how to draw the zones. After drawing the line that aligns with the EMA of interest, we will have to convert that line into a zone where we will expect to see the price action or the price reacting within that zone. Drawing these lines is done using a rectangle tool, where you can start from the lowest part of the last candlestick to the highest part of the next candlestick. Here is the illustration of what we mean. From this point, we can see that in this case, the 13 is in red and 50 in blue. After they have been crossed over, what we are now anticipating is to see the market coming to the 50 EMA. So the first thing was to draw a line on the 50, then look on the left to see where the market actually gave us a consolidation or a reversal point. So as you can see, at this point we had a point where the market actually reacted in this form. So this is the point that we are interested in. So how to draw these zones of support or zones of resistance? We start on the lowest part of this candlestick to the highest part of the next candlestick, like this, and protrude into the future. So what we are now expecting in this setup is to see the market coming back to this zone and issue our setups that we have learned before, then proceed to go down. Let's go over the charts to see how everything works. This is an example from USD against Japanese yen, and as we can see, 50, 200 crossed, and after their crossover, we now waited to see the market come back to the 200 EMA. However, at this point, we actually got to retest this zone that we took from this point. So the first thing, while the market was in play, was to look for this point where the market actually gave a reversal in the past and try to draw a zone using the M15 time frame. Unfortunately, this is an H1 time frame. Here's another example whereby we had the 200 800 crossover. After 200 800 crossover, we expected or anticipated to see the market coming to the 800, which is this one. And at the 800, the market did not stop, but it went on to the zone of reversal that once happened in the past, which is this one. And from there, we actually drew this zone from this point using the same principles that we have said earlier on. First thing is to look for the zone for the EMA whereby you wish to see the market coming back. After looking for that, try to find the nearest point of reversal or consolidation that happened in the past and draw your zone where you will be looking to see reversal reactions of the market within. Then here's the last one whereby we saw a 50-200 crossover. After that, we saw the market going up. We knew that the market was going to retest the zone of the 200 EMA, and it happened whereby if we would draw a line on the 200 EMA, it was going to protrude to this zone, and drawing this zone from this point was going to give us our pristine entry. So that's how you can draw high probable support and resistances within your trading. Try to backtest it before you incorporate it in your trading. Try to actually look at several pairs and look how everything goes before you actually incorporate it in your trading. On that note, we come to the end of this video. Thank you for watching. Like and subscribe, and don't forget to share with someone.